Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. As stocks come off a strong April, they continue their upward momentum on bets that the worst is over for the economy. However, now might be a good time to present both the bullish and bearish case for the stock market to try to put this market in some perspective for you, the investor. We'll do that now with editor-at-large Steve Reitmeister, senior market analyst Charles Rotblatt, and top market technician Kevin Matris, all here at the round table. Kevin, we're going to start with you this time because we rarely do that because you've probably been the most bullish out of the group here. Without quoting any numbers from earlier this year.
You can.
What do you think? Have we really seen the bottom, and are we going higher from here, or is this just a big bear rally?
You know, who knows? How's that?
Well, thank you. Okay, that's all we have time
for. You know, who knows? The prediction that I had earlier this year of maybe 10 or 11,000, who knows if that's going to come true? Of course, we have to get over 9,000 first for any of that stuff to even happen. But it's really hard to put a target on the market right now, but it does seem as if the market wants to push higher. In spite of the tremendous amount of skepticism that this recent rally has brought with it, every single pullback has been relatively shallow, and people on the sidelines have been using this as an opportunity to get back in.
Right.
Taking a look at the economic numbers, yeah, you know, most people still believe that the economy is going to get worse, although not at the same pace it had been getting worse at before. Plus, too, everything is relative. If you were to take a look at earnings this season, this quarter, I think growth rates are down roughly 35% from last year at this time. Yet roughly 2/3 of the companies that have reported have beat expectations, and that is why the market is rewarding these companies. The doom and gloom scenario has not been seen, and I think the market is repricing itself. So if you take a look at where we are today, we are where we were prior to the market breaking out to the downside, putting in that big last leg to the bottom, right? But again, everybody thought the world was going to come to an end. Clearly it hasn't, so the market tested the downside, that was rejected. Now the market seems like it wants to retest, or I should say, test anew the upside, so we're going to have to see what happens.
So then, is the Dow going to 14,000 by the end of the year? I'm sorry, I couldn't resist.
Maybe not by the end of the year, but eventually.
He's aggressive enough as it is, you don't need to push it.
I shouldn't encourage him, should I? Charles has been our own Dr. Doom here of late, so you've been a little bit more gloomy than Kevin and Steve on the market.
Just a tad. By the way, gentlemen, nice jackets.
Just uniform.
I got the memo.
Nice.
But, you know, one thing we're seeing here, kind of to build what Kevin said, is there's been an increased tolerance for risk. We're seeing people going into more risky stocks. And if you look at some of the stocks leading the rally, I talked about this on our Zacks Elite website on Friday. It's things like Citigroup. We're seeing the home builders. We're seeing the semiconductors. So a lot of people are assuming that the worst is over. And as a result, they're buying stocks. And to a certain point, the economic data does really support it. If you look at the numbers on the slide here, the ISM has actually improved for 4 consecutive months. The manufacturing survey is still showing a contracting economy, but the pace of deterioration is not as bad as it was, and that's a positive sign. And if we look at non-farm payrolls right now, the consensus forecast, according to Bloomberg, is for 630,000 jobs being lost. That would be an improvement over March. However, we're still looking at a contracting economy and still looking at a lot of jobs lost. But a lot of people are trying to bet that the market is once again going to foresee the recovery in the economy and are trying to buy ahead of the eventual recovery. And that's why we're seeing stocks move forward.
And somehow in that whole answer, I detect a note of warning in there for investors.
Well, but we're going to get that when we get to the bearish case, because you know that's part of the story here. Is that there's there's a bullish case for that, and there's a reason why the stocks are rallying, but there's a reason maybe not to get ahead of ourselves, and so we'll hit that on the way back as we swing back around. But yeah, to play out the bullish case right now, if Charles, if you could put back up that information you had here. If you take a look at the January non-farm payrolls, one of the things that they talk about is that I think it's 3 to 4 months after the peak in the weekly jobless claims, is when there's quite often a recovery. So in other words, unemployment continues to go lower, but the worst weekly number is usually 3 to 4 months before the end of the recession. That's one of the things that history has shown. As far as your ISM, yeah, 50 is the point of, above 50 is positive for the economy, below 50. And here again, we took a big swing underneath, but here again, it's the direction in which it's going. And people are saying, well, it's kind of like a car. If a car is going 100 miles an hour in the wrong direction, okay, it can't just turn around and start going the right direction. It has to get to 60 miles an hour, then 40 miles an hour, and then all of a sudden it gets slow enough that it can turn around. And so what we have here is we're no longer going 100 miles an hour in the wrong direction. We are going 40 to 50 miles an hour in the wrong direction, which is people taking a look at the positive sign. We've talked here before that, fundamentally speaking, the market is probably appropriately valued at 8,000. So that swing down to 6,500, we understand why that probably was a little bit too much at this time. But going above this mark just seems like a little bit much. But the market wants to rally. It just keeps disregarding the bad economic news, and it seems to want to rally. That's the bullish case. Economic numbers not so bad. No, everyone's numb to bad news when it comes out. The market rallies.
Yeah, let's look to the bearish side of things now. Charles, we'll come back to you for that. Is this too much too soon? Does the willingness of investors to look beyond the bad news scare you here?
Well, it's interesting. A lot of hoopla was made about how great April was, and the reality is April was really two different markets. If you look at the first half of April, the Dow rose 5.5%. Very impressive. But had you bought on April 16th and sold on April 30th, the Dow only rose 43 points or 0.5% the entire time. So we saw this huge rally throughout early March and early April, and then it really lost steam. And we've looked at volume really kind of drop off. We've looked at a market that's essentially been trendless since that time. So it's very positive from a technical standpoint whenever you do have a huge rally in either a stock or an index to see it kind of level off. But it does suggest that some of the buyers may be done buying and now they're waiting. The other two things, and I've said this before, that worry me, A, is the banks. We do have the stress tests supposedly being released on Thursday. Citigroup evidently is lobbying hard, trying to say, oh, business is fine, even though it's not. So we have that whole problem. How much belief are we going to have in the stress test? What happens afterwards? We're also looking at GM. Counter proposals coming out by the bondholders would wipe out the shareholders. I believe it would give existing shareholders a 1% stake. But you're looking at a possibility of GM getting messy. And if that gets messy, that's going to drag down shares of Ford, another stock that did very well in March and early April. It's going to cause a disruption across the entire automotive sector and could have a bad ripple effect for the economy. So I do think you have these warning signals. We're still seeing more estimates being cut than raised, even though that ratio is still improving. So I think it's very important for people to realize we're not out of the woods. We are seeing improving signs, but it's still improving. It just means we're going downhill at a slower pace. We still are going downhill.
Kevin, you look at the charts on a daily basis a lot. Is the market getting set up here for another big fall? Unless, of course, it's not.
Very profound.
It's an inside joke.
Let me see if I can outline the bearish case. If I were to outline the bearish case, I'd have to go point to all of the things I used to make my bullish case. The economy is getting worse. If you look at growth rates, this year comparison to last year, they're terrible. Valuations have increased significantly, almost 30%, without any kind of meaningful increase in growth rates. If you look at the charts, you can see the market has been moving higher, and this is the thing that's got me and I think a lot of other people concerned, is that as the market has been going higher, you see the volume continuing to lessen. So again, in some sense, that implies that the rally could be running out of steam. However, the contrarian view could be that the market is just simply consolidating, simply building a base. And if we can break out of this 82, 83 area, because again, everybody keeps talking about this magic number, 8,000, 81, 82. If you look at where we are prior to the recent collapse, we're still within that same range. If you can make a significant breakout, which is what we've been talking about for the last several weeks, if you can make a significant breakout to new highs on a meaningful increase in volume, I think that's going to bring in a lot of the sideline money. But again, the bearish case is still there. Things are not all rosy, and things have been a little less bad, but they're still not good.
So why might this be a sucker's rally?
Yeah, he has a hard time painting the bearish picture. He tried so hard. It was a valiant effort, but we really just can't do it. No, the bearish case is Charles gave one piece of that picture. 2 out of every 3 stocks beat their earnings numbers this quarter, but 1 out of every 3 stocks is having upward estimate revisions going forward, meaning that the analysts took the surprises and said, "Wow, that was a lot of accounting magic, and and a lot of and the revenue numbers were terrible." Going forward, two companies out of every 3 are seeing downward estimate revisions. That's not a good sign. Okay, so and here again, if we're going to talk about valuations, okay, if earnings are lower for companies and the stock market's going higher, that means valuations are getting more stretched. So that's one. The other thing is this idea that we're so used to a normal recession. And right, a normal recession is the numbers are bad, they get less bad, and then we get good. The difference here being that this is one of those once every few generation phenomenons, and my fear is that we can linger under 0 growth rate for a long period of time. So in other words, what people are saying is, hey, things are getting less worse. But in their mind, they think that means that we'll be good like 6 months from now. And my fear is that we could still have a year or 2 years, say 4 to 8 quarters of sub-0 growth, right? Negative numbers, and that would have people question this rally that we've had, and not necessarily retest 6,500, but kind of hard to say why we would press any higher given that kind of economic outlook.
So I need a one-word answer: bullish or bearish?
I believe it will rally to 9,000. Everyone gets sucked in, and we come right back down.
Bullish or bearish?
I'm bearish. But I want to say one thing to Steve's point.
But that's more than one word. I don't have time.
One sentence.
We
can't
could
do
see
it.
growth next year, but if it's only 1%, it'll show growth, but people will really feel like it's still a recession.
Bullish or bearish?
Cautiously bullish.
Okay. Hopefully that puts it in some perspective for you. With everybody here at the round table, I'm Terry Ruffalo.